listen-only mode.
Good morning. Welcome everybody to this fortnightly market outlook webinar. It is an important update, and I hope more customers, relationship managers are joining. Do send the link to your colleagues, your friends, and ask for everyone to join. This is going to be a very important webinar. So, good morning once again. I am Devarsh. I am joined by my two colleagues, Nagaraj and Siddharth. Nagaraj, good morning.
Hi, good morning, everyone. Welcome to Fortnightly Market Outlook webinar.
Hi, Siddharth. How are you doing?
Good morning, everyone. Welcome to the webinar.
Okay. So the flow, sorry, the flow of the webinar will be like this. First, my colleague Nagaraj will share his insights from the technical perspective. Then Siddharth will come in. He will share insights from derivative markets. And in the end, I will try to cover the important global events, the market outlook, try to summarize what we have discussed, and also share the recent performance, the open recommendations which we have. So without further ado, let me invite Nagaraj. Over to you, Nagaraj.
Thank you, Devarsh. Is my screen visible?
Yes. Go ahead.
Okay. Yes. Hi, friends. Good morning once again, and welcome to Fortnightly Market Outlook webinar. What we can observe over here is first we will discuss about the market from the smaller time frame to larger time frame, how market has behaved technically, what are the patterns, what are the indications are signaling towards the market. As we all know that market is in a downtrend. From a smaller time frame to larger time frame, we'll discuss and we'll come to the conclusion where the market is going to be over the next 7 days or 15 days in the next coming weeks. So on the daily chart, what we can observe here, this is a daily chart.
Put it on the that full screen mode. It is very small.
Okay. Yeah. Sorry. Yeah.
Next one.
Yeah. Okay. Right. Now it is visible properly, I think. Okay, friends, as I'm mentioning you that market on the daily time frame, what we can observe is a range mode action over the last few sessions. After that, market declined lower. This is the area where you can see a doji kind of a pattern was formed, and this is highlighting that the complete indecision at the lower levels. We don't know whether it is reversal kind of a pattern or a downtrend continuation pattern, but there is a confusion is set around the support. So market has reacted strongly from the high of 19,850. It happens to be a strong resistance, and after that made an attempt of upside bounce from the lower levels. In the previous session on Thursday, bulls made an attempt to show upside bounces, and on Friday also made an attempt, but attempt failed towards the end, and market is closed near the immediate support. This marked circle is indicating that doji pattern, and placed at the support, which is indicating that the immediate support of 19,500, 480, which was holding over the last few weeks, is likely to be broken on the downside. So this is on the daily time frame. This is the weekly time frame, friends. Weekly time frame, still the market has declined, and last week as of now on the larger time frame front, we are not seeing any kind of a reversal as of now. After the formation of hammer, this circle, this triangle, a horizontal indicating the hammer pattern. This is the hammer. After that, we have seen the confirmation of a hammer by the way of the closing the subsequent month. These two previous and last week's candle has been negated this week, and on a Friday we have seen decline, and net to net over the week we have seen 1% cut as per weekly time frame on the weekly chart, which is indicating that weak bias for the market. Even though after the formation of this bullish candlestick pattern in the previous 2 weeks, after holding above the important support of 10-week EMA. This yellow color line is a 10-week EMA, which was holding over the last 4 months. Nifty was not able to make any significant upside bounce from there from the support. Initially, we have seen a significant upside bounces from this 10-week support, but last time, despite having moved above this support and forming a bullish candlestick pattern, market has failed to show any significant upside bounce. This last week's negative candle is clearly indicating that bulls have tired at the high levels. 19,850 is strong resistance. Market is not at all willing to show any upside bounces. That ultimately results is a downside. Downside is likely. So on the weekly chart, Nifty has just closed below the support of 10-week EMA and is expected to slide below the next support. This green line is the next support, which is something around 19,300, 350. The low of the hammer candle is also placed at 19,350. So I'm expecting this 19,480, 500 support is going to be broken by next week, and Nifty is likely to reach down to the next important support of 19,300, 350, which is the low of the hammer candle of the previous week, as well as the 20-week EMA. If you look at the 20-week EMA, this arrow indicates that this 20-week EMA has been holding on the market over the last 4 months. So what does it mean? Whether we are going to show a upside bounce, whether are we going to see a significant reversal at the 19,300 level, which happens to be a strong resistance, strong support. But friends, if you look at the chart, the signal the market is showing after sustaining above the 10-week EMA, which was the important support, market has failed to show upside bounces. Now it is breaking below the support of 10-week EMA. That clearly indicating, though market slips down to the slide down to the immediate support of 19,300, 350, there is a higher chance of this support breaking on lower side. I'm not saying one way it is going to break down. There may be a small upside bounce, 1 or 2 sessions, 100, 200 points of upside bounce or short covering type of a movement from the 19,300, 350 levels. But the overall chart pattern is indicating that eventually we are going to see the downside breakout of 19,300, 350 levels, which is going to be very important for the market. If this happens, then we are likely to see a deep cut in the market. So moving to, we'll see the next slide, which is a monthly time frame chart. Friends, what we can observe on the monthly over the last 4 months, market has been in a range. On the higher level, 20,000, 20,200, and the lower levels, 19,300, 9,200 has been a range so far over the last 4-5 months. And in last month, we have seen market making an attempt to break above the 19,800 resistance, made a high of 20,200 odd levels, but failed to continue with the upside breakout and decline. So we cannot conclude completely on the monthly, because monthly is not over. But on the monthly larger time frame, the things are not showing that good. It has failed to show the upside breakout, and this month we have seen the decline is coming down. So next important support parameters we can study, that is the broad market indices, the weekly mid cap and small cap. First, we'll see the weekly mid cap. We have seen a significant upside momentum in weekly mid cap over the last 25-26 weeks after shifting into this range bound action. This is some kind of a range bound action. Here, market made an attempt of upside breakout, formed a negative pattern. After that, it has shifted into a range bound action. Now, currently placed to move below the weekly time period EMA on the mid cap, which is very important, because if the mid cap breaks below 39,500, which is a 10-week EMA, which was holding over the last 6-7 months, then we are likely to see the downside breakout, sharp downside breakout in the mid cap. Then we are likely to see the good traction on the downside. Whatever the stocks they have moved up on the mid cap front, we are likely to see some significant, some severe correction in that. So this is looking weak for me. Move below this 10-week EMA is likely to bring sharp weakness on the mid cap. The same with the small cap. Small cap has made an attempt of upside breakout of this for a rising wedge kind of a pattern after such a 25-26 weeks of if the underlying showing some rising wedge type of pattern and fails to break above that pattern, that is indicating the negative bias for this small cap. And if fails to sustain above the 12,000, 13,000 level from here, the small cap is likely to come down to the lower range. This is the lower range, 12,500 levels. Small cap, chartically, if you compare the small cap and mid cap, small cap is somehow better looking compared to the mid cap. Mid cap is looking weaker. So small cap is also weaker, but not that much as compared to mid cap. So we are likely to see the further weakness in the small cap as well. So the conclusion, the friends, as I mentioned, the short-term trend of Nifty remains negative with range-bound action, and this range is now expected to expand on the downside. The long-term chart still showing positive, but the overall chart pattern is signaling that we are unlikely to see any significant upside bounce from here. 19,000 immediately placed at 19,500 to 480 levels, and I'm expecting a decline below this support in the next week. And further weakness from here could slide Nifty towards the next support of 19,300, 350. And the 300, 350 is a very strong support place, but I'm not expecting any bigger upside bounces from the 300, 350 levels. Having showed this pattern on the larger time frame chart, there is higher possibility that eventually 19,300 levels, what we are speaking, is going to be broken on the lower side. Once it breaks below 19,300 levels, we are likely to see that deep cut in the market, as well as in the broad market indices like mid cap and small cap as well. And the sectorally, banking, automobile, IT, realty are slightly outperforming as compared to the given the current nature of the market. But while energy, metal, oil and gas, pharma, and FMCG are expected to underperform in the near term. The sign of tiredness was seen in the mid and small cap segments at the higher levels. One needs to be, there is no confirmation of the reversal at though, but one needs to be very selective. Friends, when the broader market index like mid cap and small cap turns down, then whatever the stocks we have seen the rising, risen, or a sharp upside momentum we have seen some stocks, that those stocks are likely to correct down. So there is a higher possibility. One needs to be very selective in mid cap, small cap stocks from here onwards. I'm not saying that all stocks will come down, but we have to be very, very tricky. That has to be very tricky in selection of the mid cap and small cap stocks, as we are likely to see the downward correction in the benchmark index. So this is all from my side. Now I request my colleague Siddharth to take over, and he will discuss market as per derivative aspect. Over to Siddharth.
Yeah, hi, good morning. Nagaraj, can you open the PPT?
Yes. Is it visible, Siddharth?
No. It's visible now. Can you make it full screen?
Okay. Yes. Now it is visible, I think.
Correct.
Okay.
Yeah. Good morning, friends. We are going to deep dive into the fascinating world of derivatives with a particular focus on Nifty and Bank Nifty indices, along with some of the insight into sectoral indices. Let's kick things off by looking into Nifty indices. In the past week, we have witnessed a decline more than 1.10%. No, Nifty again. You have Nagaraj, first slide. Yeah. Okay. Noteworthy that index closed near weekly low levels. The decline, coupled with a rise in open interest of 4.70% on a weekly basis, suggesting that traders have built up position themselves on the short side in the Nifty future, anticipating that further downside is possible in the Nifty. If Nifty trades and sustained below 19,500 level, we'll see a major correction in the Nifty towards 19,300 and 19,000 level. We'll keep that 19,005 level keep in mind, and I will explain you about that 19,500 level, importance of 19,500 level. What particularly interesting in despite that correction in the Nifty from the higher level, the implied volatility has remained relatively stable throughout the week. This suggests that option market has maintained consistent expectations of price movement amid the market correction. Moving to the put call ratio, previous one. Moving to the put call ratio, we find Nagaraj, first slide only. Yeah, moving to the put call ratio, it is currently hovering around 0.90 level, position neither close to the overbought or oversold level, indicating a balanced sentiment among the market participants. Now let's shift to focus toward Bank Nifty. Yeah. Similar to the Nifty, we have witnessed a notable accumulation of short position in the Bank Nifty. Bank Nifty has fallen by 1.5% with a increase in open interest by 8.4% over the course of the week. Both Nifty and Bank Nifty are currently trading at a lowest level near its current week. The Bank Nifty has shown a weaker performance compared to the Nifty in the past week, which is an important observation. Despite the downward momentum, the implied volatility in the Bank Nifty has also maintained a stability over the week. The steadiness of IV can be attributed to the relatively lower premium in the option segment. In the Bank Nifty put call ratio has got attention at it is currently trading at 0.73, and it is gradually moving toward that 0.65 of oversold territory. So there is a slightly chance if Nifty sustains and Bank Nifty sustains around that current level, from 100 level, then we can expect a smaller bounce. Now we'll go to the next slide. Into the option segment by both Nifty and Bank Nifty. In the Nifty option segment, we observe that call writing within 19,500 to 19,800 level. This suggests near-term resistance at this range. On the flip side, the Nifty is expecting to find support around 19,500 level, and its now support moves towards, if breaching that 19,500, the support will move towards 19,300 level, gradually to 19,000 level. If the Nifty trades below 19,000, I already 19,000 level. So in the next slide, Bank Nifty option segment. Bank Nifty. In the Bank Nifty option segment, put writing was in around 43,500 level, followed by 43,000 level, indicating a support of in the short term around this level. Bank Nifty, on the other hand, is anticipated to face resistance around 44,000, followed by 44,500, where the calls has been written. Any closure below 43,500 would result into more fresh short built up, and perhaps the Bank Nifty pushing towards 43,000 level, gradually towards the 42,500 mark. Over the past week, we have witnessed some inventory development in Nifty. I think next slide. This is the FI to long to short ratio. I think FI to long to short is currently moving sideways from the last 2 weeks, and suggesting that it may go towards that oversold territory of 0.20, 0.10 level in coming sessions. Now, towards the sectoral analysis, you can see, I think most of the sectors, all the sectors basically has close in a negative territory. And most of the sectors are also form a built up of short positions, so we can expect a continuous correction on these sectors. Next slide. This is a heat map of that yesterday's closing. So SBI persistence see a long build up a position, where ACC and just hold on. ACC and CUB Ambuja Cement on a long unwinding. Short build up of seen in gas companies IGL, MGL. Previous slide, Nagaraj. Short build was in IGL, MGL, and short covering was seen in M6 and Muthoot Finance. You can go to the next slide. Okay, over the past week, we have witnessed some integrating development in the Nifty future market. Short position has been rise, indicating a bearish sentiment. As we explore the option market, noteworthy patterns are emerged. The highest open interest input option is currently at 19,000 level. This consideration suggests that the market may find crucial support around this level. Now, turning our attention to the resistance level, we have gained a valuable insight from the option activity. Call writing, where the trader's sales calls option has been particularly active in 19,600 to 19,800 levels. And if market closes below 19,000 level, then the highest call option may shift towards 19,500 level. The surge in the call option implies the strong potential for resistance emerges around this level in the near term. On the flip side, we observe the put writing around 19,500 level and followed by 19,000. Currently, 19,000 put has the maximum open interest built up, so we can expect Nifty gradually moving towards that level. Shifting our focus to the now Bank Nifty, let's explore what lies ahead in the index. Much like Nifty, the Bank Nifty future market experienced a surge in short positions over the past week. Looking ahead, with anticipated the projected trading range for the previous slide. Bank Nifty upcoming is spanning between 43,000 to 44,500 level. Diving into the option market, the Bank Nifty call writing activity stands out notably around 44,000 call under level, followed by a prominent presence of 44,500 level on the higher side. This pattern suggests that traders may anticipate Bank Nifty encountering resistance around this level in the near term. For the support level, we are eyeing 43,500 level, followed by 43,000. And if it is reaching that level also, then next support lies around 42,500 level, where we are expecting Bank Nifty to head towards in coming session. This level could significantly buying interest if the index experience a dip into that territory. That concludes. Stay tuned for the more updates on weekly and for that our daily derivative outlook report. Thank you for being with us. May your trading profitable and filling. That's all from my side. Over to Devarsh bhai.
Okay, is my screen visible?
Yes, it is visible.
Nagaraj, can you see the title Be Safe?
Yes, Be Safe is visible.
Okay. All right. So now I carry forward the message the message from the market is this, that we have seen a huge run up in the mid cap and small cap. It is important to be now safe in the market. Geopolitical worries are there. As we know, the war is raging. There could be more casualties there. And we have to, wherever such event happens, people take risk of the portfolios. On the other side, interest rates are rising. I'll show you how US treasuries have moved, and that results into how the cost of owning equities go up, how cost of borrowing goes up, and that impacts the profitability of the traders. State elections are there in India. 4 to 5 states are going to go to elections. Eventually, we will have central government elections in April, May. That will also lead to a lot of people pruning their positions. International markets are getting weaker. I'll show you that. We have made large gains in small and mid caps, so consolidation is inevitable there. So looking at all this, it is advisable to increase cash. It is advisable to reduce exposure, and it is advisable that we have the risk management practices in the market. So first, let us see the international markets. As you can see on the screen, the international markets are getting weaker. Some markets have gone down more than 3 to 4% also. As you can see here, Nasdaq, Shanghai, the CAC, French market, German market, all are down between 2 to 4%. Relatively, our markets have outperformed, but as global markets are weakening, chances are that our markets will also give up. Sectoral wise, the earlier gainers, the power, capital goods, consumer durable have started the correction. The automobile, real estate, metals are showing some sign of growth. This is where we have to concentrate. If we have a larger position in these stocks like capital goods and IT, we need to be cautious. Rolling 12-month FI figures. So earlier they were extremely large sellers. From 22 beginning, they are becoming a buyer. As they become buyer, the negative numbers started reducing. Eventually, in the early 2023, they become net buyers. They bought aggressively in early 23. Now gradually they are reducing their longs.
Nagaraj, you are seeing first slide only, Devarsh? Because we
Yes. Slides are not moving.
Now?
Yeah, it's
Now it is visible.
All right. So let me start again. So geopolitical worries are there, higher interest rates are there, election and political uncertainties are there, international markets are weak, and we are seeing large gains in small and mid caps. So it is advisable to be safe there. Increase cash and reduce long exposure is our advice. We would like you to reduce leverage. Risk management is the key. Here, as I've shown in the screen, the international markets, you can see DAX, Nasdaq, CAC, Shanghai, these markets have already corrected, while Indian markets are relatively strong. If international market, these markets were to go down more, we will see more and more markets pressure on our markets, and our markets can also correct. Now, as you can see on the screen, technology, capital goods, IT and consumer durables, these are the sectors which are weak, and if you have exposure here, it is advisable to reduce exposure there. Relatively, auto, real estate, metals and FMCG, these are the hiding places. if market were to correct, these areas will see lower correction compared to these areas. Now, this is a rolling 12-month FI buying chart in the cash market. So from early 2022, they have become buyers. Their net short position, their net selling is reducing. And in early 23, they were aggressive buyers. Now they are again turned seller and their net long position is coming down. This is the chart of US 10-year Treasury. It suggests that from 2020, when the COVID hit, the interest rates were 10-year US Treasury was as low as 0.3%. From that 0.3%, now we have gone as high as 5%. Recently, it hit a 4.9, and yesterday's session it has come down to 4.91. This is a major worry. US Treasury determines the interest rates across the globe. Many traders around the world borrow against these interest rates. So as these interest rates go up, the cost of owning equities across the world will go up. The multiples will contract, and that will have an impact on markets. So we have to be cautious because of this also. This chart suggests that the risk off is on because of the geopolitical uncertainty. Gold has gone to $2,000 an ounce. This is a significant mark. Above 2000 psychological barrier, we may see a rise above up to 2080 kind of a mark, which is the next important hurdle for gold. Our commodities research team, we have been bullish on gold. We have been giving bullish recommendations. We have recommended to invest in gold bees as a ETF couple of months back, and we continue to remain bullish here. As long as there is uncertainty in the global market, gold can continue to do well. What are the important events? Many central banks across India, across the globe are going to announce important interest rates decisions. Because of the earlier, the understanding was that the interest rates have peaked and it may not rise, but the message from the market is that reduction in interest rate is still far away. We are going to see decision from EU on 26th of October. On 31st of October, Bank of Japan will announce its monetary policy. 1st of November, the US FOMC, American Federal Open Market Committee, will announce its interest rates. And again on 2nd of November, Bank of England is going to announce interest rate decision. We don't expect them to increase the interest rate any further, but the language will change. Rather than being dovish, these central banks are likely to take on a little hawkish stance on back of geopolitical uncertainty, and it pass through higher crude oil, higher commodity, leading to higher inflation in future. And if inflation does not come down, they will not have a room to reduce the interest rates. So this is a major source of worry, that cost of money is going to remain elevated in 2024 first half as well. Earlier, many market experts were expecting interest rates to come down from early 24. That seems unlikely now, and that has have a repercussion on Indian markets. So all in all, message is that it is important to reduce risk. Now I go to the second portion of my presentation, discussion on open recommendations. So from 1st of May, since we started putting this slide on the weekly or fortnightly webinar, we have already issued more than 108 recommendations which have been booked. Recently, GSFC, Gujarat Alkali, IRFC, Star Cement, we have booked. And as you can see, fantastic returns of 22%, 12%, around 7 to 8% after interest rate you have been able to generate. Similarly, on the fundamental side, fantastic recommendations. More than 107 have been recently booked since May. Stocks like MRPL, IIFL Securities, Birla Soft, and Ashoka Buildcon have been recently booked. Targets have been achieved there. 3 more recommendations recently: Rico Auto, Ashoka Buildcon, and Ahluwalia Contracts. 4 more recommendations on the e-margin side or BSPL side: Prince Pipe, Tata Steel, BPL, BPCL, and SCI have been issued. So we have slowed down the flow of the recommendation looking at the market conditions. We are, if need be, going to reduce this little further. We may also book some losses prematurely on the technical side. It is important to preserve capital in a bearish market so that when market turns bullish, we can go aggressively and make more money. Apart from this, we have also issued a DIY SIP report on July 21st. 18 new recommendations have been issued. These are the ones for the people who want to put in money every month at a fixed date into stocks. It is a mix of aggressive and conservative stocks. I would advise long-term investors, SIP investors to look at these stocks and keep accumulating. As the markets correct a little bit, some stocks may go down. It is advisable to increase the exposure via SIP there. So this is what I wanted to share. Our message from the market is clear. Be safe. Opportunities will be there to make money. It is right now important to keep our wicket, and if we are in the market for longer term, opportunities are there to make money continuously. So that's what we wanted to share. Now, if you have any questions, I request you to put it in the question mark window. We will try to address them one by one. So I'll wait for a couple of minutes to question window to assemble. Oh, I can see a lot of questions already there. So Manoj is asking about individual recommendation. Some stocks are not moving. Yeah, the markets have not been in the momentum the way it was earlier. Many stocks have started showing signs of stagnation. So it is advisable to keep reviewing recommendations. That's what we are also doing. Yeah, screen was not moving earlier, but we have corrected it. Thank you for pointing it out. Any questions? Okay, by the time they ask a question, let me ask Siddharth. If you can go back to your slide, refer to that slide and see what sectors are showing the maximum open interest on the long side and short side. Siddharth?
Yeah. Oil and gas, textile, metal, then media, infrastructure, reality, those sectors saw a build-up of short position in the last week. So I'm expecting that further correction in those sectors, whether as FMCG, technology, finance, and some of the banking stock may see a revival, including metal sector also.
Okay, the performance from some sectors are diverging, as I showed in the chart. There are some sectors which are showing signs like this. Over the last fortnight, we see that the IT, consumer durables, have actually started showing the correction, and that's where money is being taken out. The outlook on metals and dollar index. So dollar is strengthening. Dollar is a risk-off currency. It is a reserve currency. If there is more geopolitical uncertainty, if there is any more risk-off in international markets, in emerging markets, so dollar may go up, and that may impact the emerging markets. So the correlation is very clear. If dollar index continue to move higher, it will have a negative impact on Indian markets. Rain, so actually Vishwanath from Maharashtra is asking about the impact of lower rains. Yes, it has impacted the rural demand. The spread of rain was very unclear. It was not across the India. Geographically, there were issues. Some months we had a very few rains, and that has impacted some specific crop, and that is why we are a little cautious on the rural demand. Stocks like TCS, where there is some buyback, it may not fall that much in the IT sector because at lower levels there is some support. We are not very bearish on large cap IT that it will fall off. The cautious stance is on mid cap and small cap, where we have already seen a sharp run up, and it is better to book some profits there. So equity investors did not move to the fixed income investing. It is important to increase the cash exposure, reduce the risk on the derivative side, on the long exposure. If you have a large MTF, BSPL position, increase the margin there. So if there is volatility, you are not forced to liquidate your position. You can remain in the game. Or over the longer term, I would like to clarify that once this geopolitical uncertainty is over and once the election related uncertainty is over, we are expecting a lot of money to come into India from global markets. The SIP flow is there in the market. Indian mutual funds have large access to that. Employee Provident Fund and other pension funds are also having access to Indian pool of saving. So that limits the downside at lower level. Indian mutual fund and Indian investors will come in to snap up the equities which is there. The cautious stance is not for the longer term investors. It is for the people who have long positions in the derivative side, future side. Those who have a large position on margin, they may need to reduce the risk. Small stocks on real estate. Nagaraj, do you have any opinion on real estate stocks?
Yes, real estate chartically looking positive. Recently it has corrected, but the overall long-term uptrend remains intact. And I mentioned in my slide that there is a possibility of slight outperformance in the real estate sector. That doesn't mean that all the stocks of the real estate sector is moving up. I have mentioned in my slide that mid cap and small caps are looking negative, and we are likely to see the downward correction in the mid cap and small cap. I strongly advise, though whatever the stocks in the real estate has moved up significantly in recent times, look to book profit, look to exit out of that stocks and prepare in a cash. I'm expecting a downward correction, even though the sector is placed at the strong note. But whenever the index turns into negative, it turns to downward correction, we are likely to see such stocks will come down. So better to be book profit or exit from the longs.
Okay, so one last question we'll take. We are at 9:40. Koti Swaran K is asking about PSU banks. So compared to the private sector banks, PSU banks have been outperforming. We have been bullish on that sector. The upcoming quarterly results will determine the trend. I am expecting them to outperform. I'm expecting results to be good. And if they continue to show good numbers, there is chances that at lower levels we should accumulate them at after the results. If results are good, there could be some breakouts on PSU banks. So I continue to remain bullish. We continue to like that space. We will watch out for the quarterly results, and once the results are out and if they are above market expectation, we can expect some fireworks there around Diwali. Okay, that brings us to the end of this webinar. I hope the message is clear. The message has been useful to you. We would like you to share your feedback. You can connect with us and share about any suggestions you have. Thank you, Nagaraj. Thank you, Siddharth, for
Thank
joining.
you.
This concludes our webinar. Thank you. Have a great weekend ahead.